The broadcast is now starting. All attendees are in listen-only mode.
Hello and thank you all for joining us for today's webinar, Transportation, Inflation, and the Supply Chain. This webinar will be led by Remy's Chief Economist and CEO, Fred Treyz. Fred will present for about an hour, and the last 10 minutes is designated for questions. From here, I'll pass it on to Fred. Thank you.
Okay, thank you very much, Amanda, and thanks to everyone for joining us today. This presentation is about transportation, inflation, and the supply chain. And just an overview of what I'm going to be talking about today is first that inflation is economic problem number one, as was really emphasized last night in the President's State of the Union address. People are feeling this. This is a major concern. Next, we'll show included in this presentation is a couple of simulations using the Remy TranSight model to show how supply shocks impact inflation, and we'll be looking at commodity access and how that impacts inflation when there are supply chain disruptions or frictions, and also looking at the effect of an oil price shock, which is very relevant today with the price of crude spiking well over $100 a barrel. The point of how we're looking at inflation is specifically how transportation investments can reduce inflation by reducing supply chain bottlenecks. Up till now, we've sort of been looking to the Federal Reserve and fiscal policy to get us through the pandemic and to basically take the lead in resolving economic problems that we have. But now the Federal Reserve policy is caught in a trap, almost like a stagflationary trap, where employment is high, inflation is running at a very high level, but then if the inflation is being caused not necessarily by not only demand increase but also supply disruptions, and the only tool that the Fed has really is to raise interest rates and reduce demand, that may not be enough to reduce inflation back to a reasonable level. So focusing on the fundamentals, how do we improve the productivity economy, and sort of taking into account that the fundamental of the equation is how many people are working and what is the output per person, then reducing friction in transportation is a way of increasing that productivity, increasing the output per person by being able to get goods from point A to point B, and all the other benefits we have of transportation improvements. So we can, just as an overview, we can think of various inflationary factors, and then I'm going to be looking at deflationary factors. And the inflationary is monetary policy. So this has been very aggressive since the pandemic, which includes quantitative easing and a near zero Fed funds rate. I just looked at the M1 in the 1970s, like everybody would be, the financial markets would be on the edge of their seat looking for the M1 measure of the money supply, the deposits people have there in accounts and other liquid financial assets. Nobody's really talking that much about it, but it went pre-pandemic from 4 trillion up to 20 trillion today. So there's been a big expansion in the money supply. But then that sort of led to too much money chasing too few goods, which ends up being inflationary. Also, fiscal policy has been quite aggressive too, with the CARES Act, the American Rescue Plan, putting money in people's pockets, getting us through the pandemic. But some of that relief fund was not necessarily related to actually producing goods and services. So you've provided stimulus checks, but not necessarily increased the output of the workforce. And then supply chain disruption. So we've heard a lot about this. Closure of factories in 2020. So they were shut down, but then as people switched demand from goods to services, the demand for manufacturers grew faster than services, leading to scarcity of used cars, motor vehicles, especially manufactured goods, while at the same time the service sector has had a lot of disruptions, which has made it difficult for people to productively deliver services, just restaurant meals out. There's been a big increase in imports, financed with the US fiscal deficit, financed in part by trade deficit, but that's led to an expansion of 20% in imports and has contributed to the clogging of the courts. Then there's shocks. We saw just recently the Ambassador Bridge shutting down in Canada to Michigan, which caused temporarily motor vehicle plant closures. That's just one supply disruption. And then, of course, the recent events with the invasion of the Ukraine have led to a significant oil price shock, which we've seen before has led to inflation, recession. So that's these supply chain issues on supply side issues continue to dog the economy. And then also our labor shortages, the great resignation and early retirement, lower labor force participation, substantially lower immigration, and then what's needed to sort of retrain workers who've been remote or just re-entering and coming back online to work at a job. There are some deflationary factors, and this is what the Fed had been really worried about, is that for year after year trying to hit that 2% inflation target, and they've succeeded, more than succeeded, and well above that 2%. So that frustration of not being able to get inflation high enough is pretty much gone. But what are the reasons for these deflationary trends? One of them is new technology, for example, adoption of self-checkout and just sort of the ongoing technological improvements that make work more productive year by year. And there are lots of developments out there in the private and public sector to think about how to make the workforce more productive. Globalization has also been a deflationary factor, being able to get less expensive goods imported into the US, often from lower cost locations. However, globalization right now seems to be taking a step backward with these frictions, of course, with everything that's going on with Russia, and then also just frictions in terms of that supply chain. So that's been less of a deflationary factor than it has been over the last couple of decades. The aging of the population is also a deflationary factor, with the idea that as people retire, get older or retire, they become more risk averse, reduce spending because they don't want to take the risk of a risky investment or overconsumption and not leaving enough for their long-term retirement. And then the third potentially deflationary factor, not clear, is remote. So for example, there may be some productivity increases by people being able to work remotely. That little graphic over there on the right, that is not a coronavirus. That is actually a little graphic representing remote work. And it also allows people to shift to a lower cost location. But the jury's still out on whether remote increases or reduces productivity. Certainly there's a lot of interest in many firms, sort of the financial firms in New York, sort of leading this effort to bring people back into the office, presumably because they feel that it would be more productive to have people in the office, and that would that would, be in the interests of the profitability of their firms. So the topic overview is on the inflation issue. I wanted to focus specifically on the impacts on middle and lower income people, and I think that's where we see sort of the political economy really playing out here. Is that inflation puts a particular burden on middle and lower income people, since an increase in the price of gas begins to cut into other necessities, rent, food, other necessities. Whereas for higher income people, there's a lot of discretionary spending. So if the price of gas goes up, maybe it just means some of that discretionary spending pulls back. So it's not felt quite in the same way. And we've seen this in motor vehicle prices, housing and rents, particularly in the housing market. Is for those who own their own home, inflation means the value of their home goes up. So in economic terms, that might mean that the imputed rent goes up. But if one is a homeowner, the imputed rent is the theoretical rent that you would pay to yourself if you're renting your own home. But since you own your own home, it doesn't matter. And in fact, there's been some appreciation in the home value. So the assets of the homeowner increases, but rents, obviously, they're charged to the tenants, and that places a huge squeeze, especially in some of the southern cities where people have been moving to, such as Tampa and regions in Texas. Next, I want to be talking about transportation specifically, and the infrastructure investments supporting the efficient flow of goods and services. And transportation, of course, is central to the supply chain. It's like how goods get from one place to another. And it's really critical in this time of just-in-time inventory management. We've seen how, like, one little breakage in the link, for example, the Ambassador Bridge from Canada to the US, with just-in-time, there's not a large inventory of parts at the auto assembly plants. They're expecting deliveries on a day-to-day basis. So if you have one disruption in that link, it can actually close down factories. And the simulations I'll be showing are reduced commodity access and an oil supply shock. So as I mentioned, inflation is particularly difficult for middle and lower income people. And at Remy, we're focused on policy analysis. So the political dimension and policy dimension is important. We look sort of beyond the financial markets to how it impacts people, how it impacts public policy choices. And lower income groups and middle income groups, of course, spend a high proportion of income on non-discretionary spending or necessities: gas, housing, food, clothing, other areas, and plus during this whole post-COVID period, there's been a lot of monetary policy has created a lot of asset appreciation. So higher wealth individuals who started out with assets at the beginning of COVID have benefited from a big increase in the asset appreciation. So a little bit of inflation is more than offset with that appreciation in the stock market and housing prices and other types of asset appreciation. But that isn't available for those who didn't have assets at the beginning of COVID. So again, sort of this whole 2-year period really does disproportionately impact the middle and lower income households. And then COVID itself has disrupted work for everybody to some extent, but again, some people in professional positions have been able to move readily to remote, but many jobs, I mean, that doesn't account for the vast majority of jobs in the U.S. So that's been a further really blow to the well-being of many people in the United States. So just to sort of get in a modeling and simulation point of view, I have a fairly straightforward simulation, which is not an official study, but just to show the interaction between commodity access and inflation. And commodity access is basically the transportation and logistics costs for commodity shipments from one region to another. For this, I use a multi-regional TranSight US model constructed of 9 major metro areas as each as a separate region, and then the remaining rest of the United States comprises a distinct region in the model. So if you took out a map of the US, you have 9 major metro areas as distinct regional economies, the rest of the US as a distinct regional economy, and then the multi-regional model means that the economies of these individual areas interact with each other in terms of trade, migration of people from one area to the next, commuting between regions, and other economic interactions between regions. Then I simulate a 10% disruption in 2022, and then I move it down to a 3% in 2023, and showing the results for consumer prices by quintile and also employment. So here's how I enter this into the model. I've clicked on the policy variable selection. I've gone to commodity access index, and then we have across all manufacturing a 10% decrease in commodity access index in 2022 and a 3% decrease in 2023. The economic summary then is broken down by region. So this shows the nine metro areas in this model, and the rest of the U.S. And it pretty much crosses all regions with a negative impact on unemployment. This now shows the effect of reduced commodity access on consumer prices, and it's broken down by quintiles. So it's going from left to right. It's the lowest 20% of compensation earners, but this is showing the effect of inflation. So basically, we've taken information on the typical basket of goods and services that each quintile consumes, and then calculated a specific inflation rate for those groups. And we can see that it's the inflation rate by group for this commodity access is relatively proportionally equal, about 0.54% across each of the groups. However, the economic impact, because the higher income groups often have the higher asset appreciation, and also the higher income groups have more discretionary income that can be cut back on, this increase in prices for the middle and lower income groups often means difficult choices in terms of what other necessities have to be given up. The commodity access, if we look at what the effect is over time, REMI TranSight and the Remy models are dynamic models. So the effects then carry out over time. Of course, in 2022, there's the 10% reduction in commodity access. 2023, it goes down to 3%, but then that disruption that occurs in 2022, 2023 carries on with inflationary effects quite strong in 2024, still there in 2025, and going out into the future. Now, why does this happen? Well, it may mean if there's a disruption in the supply chain in the short term, firms may just draw down their inventory. So there's a disruption in the supply chain, and rather than pass the cost on instantaneously to the consumer, there may be a drawdown of inventories initially without changing the price, but then as time goes on, then with the inventories lower, they need to be replaced at a higher cost. So firms will begin to pass some of these inflationary and supply disruption effects into a future year. Now, I guess if we get back to what the challenge is for the Federal Reserve is that suppose all supply chains disruptions ended immediately, suppose any sort of oil supply shock went away instantaneously, well, there still may be a carry-on effect because those costs have gone up, inventories have gone down, and those costs may be passed into future years. Next we can get away. We move from this scenario to look at the contribution of transportation infrastructure in terms of having a productive, efficient, low-cost economy. So sometimes we get caught up in the doings of fiscal policy and monetary policy in the Federal Reserve and various stimulus programs at in fiscal policy. But sometimes it's good to just get back to the fundamentals of economic growth, and they are how many people are working and what is the output per worker. And basically, you can't get away from these fundamentals. The number of people working has pulled back a little bit with COVID. Labor force participation rates are down, but they've been coming back, albeit gradually. And then also output per worker is how much each worker can produce. And when we're looking at the supply chain and transportation, the productivity has gone down when the ports get clogged up, when there's not an availability of truck drivers, when the Ambassador Bridge closes down in Canada, that takes a hit to worker productivity. So the root causes are really what matters, and transportation is a root cause of labor productivity. Essentially, do we have an efficient supply chain that we can manage the logistics costs? And I mean, there have been great strides in terms of how firms and auto assembly firms, for example, and many other firms can manage a supply chain that draws all across the U.S. and all across the world. So we've seen a lot of these efficiencies going into increasing productivity in the past. And now the question is, can we keep these efficiencies and keep growing these efficiencies into the future? And transportation investments in this context should be viewed in terms of improving productivity, improving the output per worker, specifically by getting inputs in production and the final goods out to consumers in an efficient manner. So how does this work in the Remy TranSight model? We see here that if we're looking at a transportation project, there's basic bread and butter project-specific data. For example, if you're expanding a port or expanding a roadway or rail or some other means of transportation, there's construction expenditure, operation expenditure. There's also going to be the question of where the financing comes from. It could be in part federal financing, or also increasing issuing bonds, tolls, or drawing from general revenues. But the purpose of transportation is not just to have construction and have taxes, but the purpose is to speed up the flow of goods and services. So either using a transportation model or using other data that's available, we can look at the flow in the transportation networks. This is directed towards roadways and highways, VMT and VHT. So basically, the vehicle's mile traveled, the vehicle hours traveled, you have increases in speeds in transportation. And that will drive fuel demand, emissions, safety, and then particularly it drives time savings, so that gets back to the productivity of our transportation system. These are then converted into changes in the transportation cost matrix. Remy policy variables run through the TranSight model to drive economic and demographic results. So in a very simple format, the previous simulation showed how increase in labor force in it was actually a negative effect in commodity access index, but if you increase that, then it will reduce transportation costs and increase economic activity due to lower transportation. The TranSight methodology integrates various economic modeling approaches and has the strengths of each of these approaches. So general equilibrium factors, which would show the response in terms of how businesses will respond to cost and price changes, and when those changes occur, that there will be a process where there will be a new equilibrium, which could increase output or reduce output depending on whether the costs go up or down. It also integrates input-output methodologies, in particular the inter-industry transactions that take place, so that if you have a change in auto assembly, then all the parts suppliers will be affected along the supply chain. So input-output really does directly deal with the supply chain. The equations are estimated econometrically, and then also Remy incorporates the new economic geography, which measures the productivity benefits that come from clusters of industries and agglomeration of economic activity. We have some of our representative uses over on the right hand side. And in particular, when we're looking at this type of issue, when we're looking at inflation, when we're looking at improving productivity and transportation and having that lead to economic output, that really reflects the difference between static analysis and dynamic analysis. So Remy is providing everything that comes out of static analysis to be able to evaluate construction spending, operation, and maintenance spending. But the whole purpose of transportation investments is for travel time savings and improvements in savings, network speed improvements, and then how those network speed improvements and access to intermediate inputs lead to increased economic competitiveness and drive economic growth in a region or in the US as a whole. And at the bottom, there's a little blurb from FHWA stating that TranSight is among the best equipped to estimate productivity impacts. So we really want to stress the importance of being able to look at this type of analysis through a dynamic lens. And then, of course, the model has been validated with peer-reviewed model equations. We can go back and provide the basic research published in the American Economic Review, Journal of Regional Science, and other publications on the equations and the model structure. It's also designed for the whole time of Remy to be able to be used as a desktop application by analysts who are actually working on the project, and that it's transparent, so you know what's going on within the model. And there are thousands of variables or detailed variables that are reported. Some of the key ones are employment indicators, gross domestic product, income, output, and demographic changes. So the next scenario I'd like to show is an increase in the world price of oil and gas price by 10%. I didn't know it was going to go up by 10% this morning, but here's the scenario. And then looking at the employment effect, 9 major metro areas in the rest of the U.S. and the inflation impact by wage quintile. Now there is a little adjustment I made in this model here, where I offset some of the employment effects to keep employment stable across the U.S. to really hone in and focus on the regional effects. So the way we do this to increase the world price of oil is through this policy variable of foreign import costs in oil and gas extraction, and that's increased by 10%. And this is just done flat starting in 2022 and going out into the future. And again, we've offset this by what we call like sort of a Federal Reserve response, where the Fed can keep employment constant for the country as a whole, which I'm not sure is completely realistic given this scenario, but just really to hone in on these regional effects and then the income effects of different groups. So we can see that most areas, most every part of the U.S. Sees a negative from this effect. This is all in thousands and thousands of jobs. And then the oil producing metro area, Harris County, Texas, and the greater Houston area see increases in jobs with the higher oil prices. And then if we're looking at how this impacts different income quintiles, this is from our socioeconomic indicators, or SEI, Remy SEI module, that looks at income effects and wage effects by quintile. It also looks at jobs by race. It also looks at jobs by level of educational attainment. And this is looking at the inflationary effect. And we see it's highest for the second and middle quintile, and goes up for everyone, and the highest 20%. It's still up, but at a somewhat lower rate. But again, I think that the reason that this is such a sensitive issue for the middle class workers is that there's just not a lot of discretionary to cut back on. Rents are fixed, food costs are fixed, so there's not much to cut back on if the price of gasoline goes up. So to conclude this, and then we can open things up for questions and answers, is adverse supply shocks and supply chain disruptions continue. It's not all behind us. It's not quite as transitory as we had been hoping for 6 months ago, and in fact, with the geopolitical events and the oil price shocks, it remains a very high concern. These supply shocks exacerbates economic problem number one, which is inflation. And part of the story about inflation is excess demand, too much money, chasing too few goods. So the M1 money supply going from 4 trillion to 20 trillion, and there's not necessarily 20 trillion of goods and services that can be purchased. So part of inflation is a demand issue, but also it's partly a supply issue. The factory shuts down, the COVID disruptions, the supply chain, the supply chain events, geopolitical events. So we have both too much demand and too little supply. So the Fed challenge then really is to tamp down the inflation so it doesn't become embedded in the economy. There's plenty of examples where that's been a big problem. And the main mechanism is to increase interest rates, taper or shrink the balance sheet, which would have the effect of lowering demand side. But if supply shocks are a big part of the problem, then that demand maybe have to be reduced very significantly in order to bring demand in line with supply if there's been a negative supply shock disruption. And so to tamp down demand by tightening monetary policy places a big risk of recession, and basically this old 1970s term stagnation or stagflation, which is you have inflation, which oftentimes we associate with the growing economy because there's a lot of demand and businesses can raise their prices because there's so much demand and still sell their goods and services. But then if you have a supply shock, you can have the inflation, but then at the same time have stagnation. So even if you have slow employment growth or recession, if you have supply shocks, you can still have inflation. This isn't the cheeriest presentation, is it? But we'll take that in the Q&A period. However, I think we've had the bipartisan infrastructure law. There's a lot of funding out there for transportation improvements, ports, highway, and rail. There's much needed investment that has been deferred or hasn't necessarily been done, to the extent to maintain and upgrade these transportation systems in the last, in the last years. And this is really the way to get at the root cause of some of this of inflation, which is productivity. And if we have a more efficient transportation system, we have a more productive economy, more output per worker reduces inflation and provides a higher standard of living. The Remy TranSight model enables users to quantify these effects, and we'd be delighted to set up a time to discuss and demonstrate in more depth these various effects. And then there have been many demonstrated cases like I-95 and in North Carolina widening and others, where the economic analysis has been fundamental for informing policy decision makers and legislation to be able to invest and improve transportation. And the economic benefits of this is really what is very motivating in terms of legislation and policy outcomes, is to the link between transportation improvements and jobs, income, and other economic measures. So with that, we have time for questions and answers, and I would like to then turn this back to Amanda, who will moderate the Q&A section.
Awesome. Thank you, Fred. That was a great presentation.
Thank you.
So the first question we have is going to refer back to slide 10, I believe. The question is, it seems that the 50% to 75% quartile are the most affected by disruptions. Would it be fair to say that this group is more affected by supply chain disruptions than other income groups?
Slide 10's way back, right?
Yeah, let me know if you want me to repeat it.
It's yeah, we see the 50% and fourth, the fourth, so the third and the fourth, as you're saying?
50% to 75% is the most affected by the disruptions.
Right.
Yep. And then he said, would it be fair to say that this group is affected by supply chain more than any other income groups?
I mean, that's what this analysis shows, and I'd say that the differences between the different quartiles are not excessively different. I mean, they're like hundredths of a percent difference. So I think that really some of the concern about inflation has to do with you know, that there's not much discretionary spending. So that's why these supply chain disruptions, you know, as the president pointed out last night, are really felt very, very heavily in the middle income groups.
Okay, great. Thank you, Fred. Next question. Given the rising rates, can this lead to stagnation, as you said? Then should the Fed not raise rates as it said it would today?
Well, I think the chairman said by 25 basis points, which is really on the lower end of what some have said would be needed to reduce inflation. But of course, financial market disruption and acting too quickly and being cautious. So I mean, there are all sorts of reasons that the chairman is making that and making this decision. But the challenge is then the Fed has a dual mandate: is full employment and price stability. So many observers of the Fed has said, okay, full employment, the unemployment rate has actually been declining. The unemployment rate is low and near what some would say is full employment, or there's another term which is non-accelerating inflation rate of unemployment. So many would say that the unemployment is not that mandate to have full employment or near full employment or employment stability has been met. Now, the other side of the dual mandate that the Fed has is price stability, and that's where the Fed has been losing ground. So it suggests that the Fed needs to be aggressive in terms of getting inflation under control.
Thank you, Fred. Next question is going to be about the term supply shocks. The question is, does this mean market and goods are flooded into market because of backlog, or does it mean supply is slowly released back into market to move with inflation?
The supply shocks means like a shift in the supply curve. So basically, the world supply of oil is negatively affected by geopolitical events. So there's a scarcity, and that pushes the price up. So so you end up with your supply demand diagram, supply curve shifts, and that means lower supply and higher price. And so that's a very difficult problem for monetary policy or Fed policy to deal with. It's also very difficult for fiscal policy, and even transportation improvements and transportation investments, perhaps over a long time period, once they're up and running, will be able to increase the productivity along the supply chain, but it can't be done quickly. What can be done quickly is the Fed tightening monetary policy and reducing demand, but these increasing the supply or reducing friction along the supply chain is a longer problem to solve.
All right, thanks, Fred. Next question is, did you consider the impact of companies inflating their prices over the increase in operating costs? There seems that this practice is taking place, further pushing inflation up.
Yeah, I mean, companies will act to maximize profits. It's not necessarily shocking, and they'll be able to do that in an environment that allows them to increase the prices and still be able to sell goods and services. There may be an issue with consolidation and over consolidation, which has reduced competition among firms. But given that the inflation that the Fed has targeted for the last decade has targeted inflation to be 2% and has consistently fallen short of that 2%, that sort of suggests that there hasn't necessarily been such a massive structural problem in terms of lack of competition among U.S. firms. Let's say that if that had been a big problem, then you would have expected sort of pre-pandemic that firms would be raising prices and that 2% target would be exceeded. So I think that what's really changed is sort of post-pandemic. You've had fiscal monetary policy. You've had people dropping out of the labor force, or even those who are in the labor force. Their employment has been disrupted, and their work has been disrupted. And I think now what we're seeing is that is that the nature of the firms hasn't really changed that much from 2019 to today, but now they're in an economic environment where there's a lot of pricing power for many of these firms, and that pricing power translates into inflation.
All right, thank you, Fred. The next question is, when the Ambassador Bridge closed, how did this affect the inflation and/or transportation for both the U.S. and Canada?
Well, when the Ambassador Bridge closed, because of the just-in-time inventory management in the auto assembly, where the U.S. assembly plants depended on on-time daily delivery of auto parts from Ontario auto parts producers. So when that bridge closed down, it disrupted this just-in-time manufacturing system, closed down U.S. auto production as far as Tennessee, but particularly in the Great Lakes states in Michigan, Ohio, and so you've lost days of production, and now to make up for that production, there's some capacity because the auto production are already at capacity. There's a lot of demand for new autos. So they may not be able to fully replace that disrupted production. So now the inventories of new motor vehicles are depleted, and somebody walks onto the auto lot looking to buy a new car, and there are no discounts off list. In fact, there may be some of the vehicles may be shown over list price, and consumers are, if they want to go away driving a new car, they have to accept what's available, even if it's not exactly to their specification, and even if it's at a higher price than they might have paid a couple of years ago.
And then the follow-up question along with that one is, would I be able to view the results of a stimulation for a specific county or singular zip code, for instance, such as Michigan and Ohio, where that bridge was closed?
Yes, we can, and that, it's a great question, and actually, it would be very interesting to look, specifically which factories were being impacted by that closure, and then Remy. We can build the Remy model down to the county level for single counties or combinations of counties.
Okay, and then I have some more questions on the TranSight model. So I'm going to kind of ask you, Fred, the short version, then you can answer it, and then I'm going to kind of keep bouncing back and forth with you because there's a lot of them. So
okay.
In the TranSight model, does it have stimulation capabilities on the impact of labor shortages, including ages?
Yes. Yes. So labor, right. So in the TranSight, you can see what effect a change in the labor force participation rate has in terms of how that impacts the ability of firms to find workers.
Yeah. And does it have the capability to have deglobalization in supply chain? rethink of
Yes.
inventory management from just-in-time strategy? That's just an example of that.
Yeah, and we right, we looked with some of the trade policies in the last administration with more of a Buy American program and tariffs. We looked at how policies directed towards having more domestic production would impact the economy. So yeah, we've done a lot of work in that area.
Does TranSight stimulate autonomous trucks on resolving supply chain issues?
We've certainly thought about that issue, and we do have labor productivity policy variables. So that would that type of scenario would maybe draw from policy variables of capital investments in trucking, so more expenditure on capital, and then a more labor productivity, so fewer workers, or reduced labor intensity, so that fewer workers would be able to deliver the same amount of trucking.
Okay, and the last question on the TranSight model is, would it stimulate changing relation of a number of people working and productivity change? For example, increase due to new technology.
Yes. There is even built into the baseline forecast, economic forecast in TranSight, there are changes in labor productivity over time. There's also kind of built into it, when labor cost goes up, there's a Cobb-Douglas production function, so that if labor cost goes up, the model will automatically shift towards more capital intensive, less labor intensive. And then there are lots of policy variables and levers to be able to sort of further refine this and look at a specific development or a specific project.
Thank you, Fred. And the last question for this webinar is, do you have any outlook and forecast work on the potential impacts of Russia invading Ukraine on supply chain?
I think the biggest effect we've seen so far is the spike in oil and gas, and that's one of the key exports of Russia. Also, there's questions about wheat exports, but there's a world price of wheat, so that would increase the price of wheat, the price of bread to American consumers. U.S. is self-sufficient, more than self-sufficient in wheat, and I think many of the direct disruptions might be located with Europe. And then, I'd say another interaction would be financial market disruption. So to the extent that U.S. banks, which are really multinational banks and financial entities, are linked globally, that's also an impact of how the sanctions may then have an effect that comes back to the U.S.
All right, that sums up all the time we have for today. Thank you so much for your presentation, Fred. Do you have any last comments you would like to say?
Well, thanks for all the terrific questions and the interest, and appreciate you, everyone who's joined us to taking the time out from your busy day, and we look forward to being in touch. So thanks so much.